There were a lot of things that fell into place at that point. You had really a perfect pivot for the Fed. You had a great earnings season, and then you had a trade deal that was ready to go. And then all of a sudden, come that weekend, you had to take the trade deal off. Market's off this month about 3%. We would consider 3 to 5%, something that seems likely in that piece of new information. A couple of points to put in perspective, though. First of all, we think the Fed means more to broader risk-taking. So last year when you had the trade flare-ups, you also had Jerome Powell saying we're far away from our neutral rate. In December, you had him say we're going to go a few more times in 2019. That stuff is off the table. The other thing that's important is politics versus economics. The president is able to have a discourse like this right now because the economics is on his side. You just put up a 3% number in GDP growth in the first quarter. As we all know, the unemployment rate is very, very low. I don't think it can get to the point where it slips into economics, where it slips into the S&P. The S&P is like the president's Nielsen rating, right? So as the S&P comes off, I think
maybe the Dow.
Maybe I think it's that it wouldn't let it slip into economics. I think that's important.
Laurie, trade-related pullbacks, are they an opportunity to buy?
I think it depends on your time horizon. We've actually thought the S&P was overdue for a pullback of, we could easily see it going down to 2650, 2750, and that would be pretty normal for the kind of rebound we've had.
Your year-end target is still 2950.
Yeah, we think that we're going to muddle through. We think we're going to come out of this rough patch. The way we've put it to clients is we're not pounding the table today. We think there could be some incremental downside in the near term, but on 6 to 12-month view, we still like the market.
I mean, Phil, look at the action in semis, really rough on the latest Huawei news. What do you do if you own that sector, which has been such a market leader so far this year?
So you said market leader, and I think technology, Sarah, at times turns into a flight to quality sector for folks. People know these names, and they want to come into tech. Tech is a high beta sector, and we're seeing that now. Semis also are a big sentiment driver, right? It's a macro theme. And until this thing really does, though, slip into something that's more economics than politics, we would agree with Laurie here, but not much upside anyway for the market here. Go find other ways to play upside in the market besides just the tech sector and all those names people like.
Some of those tech names, Laurie, you think it is fair that they're pulling back?
Absolutely. And what I think is really interesting about today's market action, and we saw a little bit of this last week as well, it's not just the semis and the tech hardware names that have this direct trade exposure that are getting hit hard. Software stocks are actually underperforming today, and that's been an unbelievably crowded area. That's one of your flight to safeties that people were hiding out in. There's some plain old-fashioned profit-taking that's going on here in crowded and expensive parts of the market.
So you're saying, Phil, until we get any kind of resolution, if we get any kind of resolution on U.S.-China trade, do what?
So at this point, we don't believe that this is going to slip into economics issue. So upside from the market still exists from here, but only mid to high single digits, and the Fed is more important. So at this point,
go into defensive stocks?
And so defensive stocks and fixed income proxies, I think, make some sense because nobody's talking about interest rates jumping to 3%. We're at about a 240 to 260 range here, which makes sense for things like utilities, makes sense for things like REITs, preferred stocks. All that is okay to get carry in the portfolio. Sarah, the other thing, I know we like to talk about stocks here, high yield credit makes a ton of sense in the wait and see environment that we're in right now. You get a 6% yield and you get a little bit of spread compression, you can get the same return that you can get in equities with less volatility.